jumping straight into Coinbase Global today. Everyone is watching the price action, but the real story is the Trump administration's public backing and the push for the Clarity Act.
Exactly. You're tuned in to the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
Make sure to subscribe and hit the like button so we can keep bringing you the breakdown on the market's biggest movers.
And we definitely have a massive mover today.
A total monster. If you were, watching the ticker in that first week of March 2026, March 4th and 5th specifically, your screen was basically just flashing green.
Nonstop green.
Yeah, nonstop. The stock completely erupted. We saw a massive 14.6% spike, closing out at $208.93.
Which was a violent breakout to new highs.
Violent is the right word. You could practically feel the retail fear of missing out, just radiating through the volume charts.
Right, and institutional buyers were relentlessly accumulating shares alongside them.
Exactly. But to be clear, this wasn't some random technical bounce or a sudden change in the wind, was it?
Not even close. You can tie this spike directly to a very specific news cycle, and it revolves entirely around the intersection of finance and Washington politics.
The primary catalyst being the chief executive officer taking that highly publicized private meeting with President Trump.
Yeah, and the fallout from that meeting was immediate.
Right.
We saw public backing from the administration for the cryptocurrency sector at large.
Right.
And more importantly, their explicit support for pushing a piece of legislation known as the Clarity Act across the finish line. When the market saw that, it acted like a match dropped in a powder keg.
Just a quick timeout for our listeners before we dive deeper into we aren't here to play politics.
Absolutely not.
Whether you love the current administration or strongly disagree with them, our job today is strictly looking at how this shifts the financial chessboard. We are entirely neutral.
Completely neutral.
We aren't endorsing any policies or taking a side. We are purely analyzing this as a regulatory catalyst and looking at how Wall Street is pricing in this political maneuvering.
That is a crucial distinction because the market doesn't care about partisan lines. It cares about regulatory certainty.
Which has been basically non-existent.
Exactly. For the last several years, the entire digital asset space has been operating under what you could call regulation by enforcement.
Right. There were no clear rules of the road, just lawsuits.
That's what makes the Clarity Act so vital. It isn't just a symbolic gesture. This act is designed to formally define the boundaries between a security and a commodity in the digital space.
And it specifically provides a legal framework for things like stablecoins, too.
Yeah, which is massive. If a company knows the actual rules they have to play by, they can stop spending hundreds of millions on legal defense and start deploying that capital into growth.
The market realizes that the regulatory discount that has weighed heavily on this stock for years might suddenly be evaporating.
It's basically being priced out in real time.
That makes total sense. It's the difference between driving blindfolded and finally having a map. And speaking of growth, to really understand why investors are piling in hand over fist right now, we have to look under the hood.
At the underlying financial evolution.
Right, because they just reported their fourth quarter numbers for 2025, and they were nothing short of a jaw-dropper.
Staggering numbers.
They posted $1.78 billion in total revenue. They utterly shattered Wall Street's expectations, record trading volumes across the board.
And their crypto trading volume market share actually doubled year over year.
Hitting 6.4%. That alone is the kind of headline that gets traders excited. But okay, let's unpack this, because the real jaw-dropper isn't the trading volume.
It's what is happening behind the scenes.
Exactly. With their subscription and services revenue, they pulled in $2.8 billion in that category. Plus, the number of paid Coinbase One subscribers has tripled to almost 1 million over the last 3 years.
Which is an incredible metric.
It is, but why does Wall Street care so much about 1 million subscribers when billions of dollars are flowing through the trading engine?
Because it fundamentally changes the valuation model of the entire company. To understand why institutional investors are salivating over that $2.8 billion figure, you have to look at the traumatic history of this sector.
The crypto winter cycle.
Right. Historically, digital asset exchanges were deeply tethered to that cycle. When prices were skyrocketing, retail investors traded heavily, and the platform made a fortune, taking a small cut of every transaction.
But when the market crashed into a multi-year bear cycle,
trading volume would just evaporate overnight, revenue would plummet.
Yeah.
The business model was terrifyingly cyclical.
Right, it was feast or famine, mostly famine during the bad years.
Exactly. But this massive shift towards subscription and services revenue completely rewrites that narrative. It acts as a structural buffer against that historical volatility.
But they have a floor now.
They do. The market is waking up to the fact that they aren't just a low-margin, highly cyclical transaction processor anymore. They have evolved into a high-margin financial infrastructure pillar.
They are effectively functioning like a SaaS business. Software as a service.
And Wall Street loves SaaS businesses
Yeah.
because the revenue is predictable, recurring, and sticky.
And what is incredibly impressive is that they are maintaining very healthy operating margins, roughly 25 to 30%, even as they aggressively ramp up their marketing spend for new international product launches.
So they are building a predictable money machine on top of a volatile asset class.
But okay, hold on. Having a great business model is one thing, but surviving in this space requires a ridiculous amount of capital. I'm looking at their balance sheet right now, and they are sitting on an $11.3 billion cash war chest.
It is an absurd amount of liquidity.
How does that specific pile of cash change the game for them compared to their competitors?
It is arguably their most vital asset right now, and you have to view it as an offensive weapon, not just a safety net.
Because liquidity crunches have routinely wiped out major players almost overnight in this sector.
Exactly. Having $11.3 billion in cash and equivalents means they can outlast anyone. They can outspend rivals on product development.
They can fund aggressive mergers and acquisitions?
Yeah, to buy up smaller competitors who are struggling to survive. And they can weather any lingering regulatory storms. But more importantly, it reinforces their ultimate competitive moat, which is institutional trust.
I want to push back on that a little bit. You say they have this massive institutional moat, and I know they are currently the primary custodian for nearly every major Bitcoin and Ethereum exchange-traded fund on the market.
Which is a dominant position.
It is, but why is that a permanent moat? Why wouldn't a massive traditional finance giant, say Fidelity or Goldman Sachs, just look at the fees they're paying, build their own custody platform, and cut out the middleman entirely?
It's a great question, and the answer comes down to switching costs and asymmetric risk. Custodying digital assets isn't like holding traditional stocks in a digital ledger.
It's way more complicated.
Far more. It involves managing highly sensitive cryptographic keys, utilizing complex cold storage vaults spread across geographic locations, and maintaining military-grade cybersecurity protocols.
Right, because if an asset manager makes a mistake with traditional equities, trades can usually be reversed.
But if a digital asset is stolen, it is gone forever.
So it's a completely different infrastructure entirely.
Precisely. Once an institutional asset manager like a BlackRock or a Franklin Templeton integrates their internal systems with a custodian, moving billions of dollars in digital assets to a brand new, unproven system is a logistical and security nightmare.
It represents a massive career risk for the executives involved.
They would rather pay the established, proven leader who happens to have an $11.3 billion balance sheet backing them up than try to reinvent the wheel.
That stickiness is invaluable, and it essentially locks in those institutional relationships for years. Let's break that down even further, because their moat isn't just about acting as a digital Fort Knox for the big players. They are actually expanding the very fabric of the market itself.
The underlying architecture.
Exactly. I want to talk about their base layer 2 network. For anyone who isn't a blockchain developer, what exactly is Base, and how does it make them money?
Think of the main Ethereum network like a massive, highly secure, but incredibly congested highway. During rush hour, traffic slows to a crawl, and the tolls to use that highway get absurdly expensive.
So what did they do?
They built Base, which is essentially an express lane built directly on top of that highway. It's what we call a layer 2 network. It processes transactions incredibly quickly and cheaply, and then bundles them up to settle securely on the main highway later.
Okay, so they built an express lane. Where's the revenue?
The revenue comes from what are called sequencer fees. Because they built and managed this express lane, they act as the toll operator.
Oh, I see.
Yeah, every single time a developer builds an app on Base or a user makes a transaction on that network, the company captures a tiny fraction of a cent.
And when you multiply that by millions of daily transactions, it becomes a massive high-margin revenue stream.
Furthermore, they are taking decentralized exchange, or DX, functionality and integrating it directly into their consumer app using this Base network.
So they are actively fighting off crypto-native rivals like Uniswap.
By offering the exact same decentralized trading experience, but faster, cheaper, and within their trusted ecosystem. They are building the infrastructure, owning the toll roads, and providing the consumer interface all at once.
It really is a masterclass in vertical integration. And that points to this overarching narrative we keep hearing from analysts, the Google of finance strategy.
That's the ultimate goal.
They aren't just trying to be a crypto broker, they want to be the everything exchange. Imagine waking up, opening a single app on your phone, and seamlessly moving your money from Apple stock into Bitcoin, and then placing a wager on the upcoming presidential election.
And they are actually making moves to do exactly that. They are partnering with Kalshi to integrate prediction markets.
They are pushing heavily into the tokenization of traditional assets.
And they are expanding aggressively overseas. The global expansion is critical to that vision. They aren't waiting around for the U.S. regulators to figure everything out.
They recently secured major licensing wins in the European Union under the Markets in Crypto Assets Regulation, better known as MiCA.
Which gives them a clear legal passport to operate across the entire EU bloc. They are also expanding aggressively into emerging markets like Brazil.
They are methodically laying the groundwork to be a globally regulated, omni-channel financial hub.
And Wall Street is absolutely taking notice. While we obviously don't deal in specific rating labels like telling you to buy or sell, the broader analyst sentiment is incredibly constructive right now.
To give you a flavor of the aggressive forecasts out there, Bernstein recently put out a price target of $440.
Think about that.
Even with the massive spike we just saw, up to around $209, that target implies a massive 112% upside from current levels.
The market is slowly waking up and pricing in this transition from a simple brokerage app to a foundational layer of the global financial system.
It's an incredibly compelling narrative, but anytime you see an implied upside of over 100%, you have to stress test the thesis. A transition of that magnitude doesn't happen without significant friction, immense execution risk, and some very real vulnerabilities.
Which is exactly why we need to flip the script.
Looking at the flip side, we have to talk about the risks, because the bear case here is very real, and it has teeth. And the biggest, most immediate anchor dragging on this entire bull narrative is still the flagship asset itself.
Bitcoin.
Right.
This raises the most critical question for any investor in this space.
Yeah.
What happens if the underlying asset class stalls out? Bitcoin's ongoing consolidation is the primary threat to the current valuation.
Because over the last few months, we've watched Bitcoin repeatedly try to break out, only to fail to sustain any meaningful rebounds above the $70,000 mark.
And if the broader macroeconomic environment shifts, maybe inflation ticks up, or the Federal Reserve gets hawkish, and Bitcoin breaks down below its core support levels, specifically falling below $60,000, the ripple effects would be immediate.
We would likely see a sharp, violent contraction in retail interest.
Let's not forget, despite this beautiful SaaS evolution we just discussed, a very significant portion of their revenue is still deeply tied to retail transaction volumes.
If the flagship asset enters a prolonged consolidation or a deep correction, that retail FOMO disappears.
Trading volumes will inevitably drop, and those highly profitable transaction revenues will contract sharply alongside it.
Okay, I hear you, and the historical charts definitely validate that fear. A Bitcoin crash has always meant a catastrophic quarter for the exchanges. But let me play devil's advocate here.
Go for it.
Didn't you just explain how that $2.8 billion in subscription and services revenue is a structural buffer? Doesn't that recurring revenue act as a massive shock absorber that simply didn't exist in previous market cycles?
It does.
Plus, if we look back to earlier in 2026, the stock already went through a brutal 30% year-to-date correction. Hasn't a lot of the froth and the immediate downside risk regarding Bitcoin's consolidation already been priced in at these levels?
It's a fair counter-argument.
Yeah.
And yes, the structural buffer is exponentially stronger now than it was during the last major downturn. The floor is undoubtedly higher.
Oh.
However, you can't understate the psychological impact on the market. If Bitcoin drops 20%, retail investors stop logging into the app. They stop trading altcoins. They might even cancel those premium subscriptions.
The buffer softens the blow, but it doesn't make them bulletproof.
And honestly, the risks aren't just isolated to the price action of Bitcoin. We have to look at the massive regulatory tightrope they're still walking.
Right, because we started the show talking about the Trump administration and the Clarity Act as this massive bullish catalyst. But Washington moves at a glacial pace.
Precisely. What if that legislation stalls? Passing comprehensive financial regulation is notoriously difficult, even with executive support.
What if political priorities suddenly shift to a different crisis?
Or the administration changes its stance after facing pushback from legacy banking lobbyists. We could easily see the Clarity Act delayed indefinitely in congressional committees.
Or worse, different regulatory agencies could issue new conflicting rules that create burdensome compliance costs.
The market has aggressively priced in a regulatory win based on that private meeting.
Yeah.
If that win evaporates into political gridlock, the premium on the stock could vanish just as quickly.
And even if they manage to navigate the politics perfectly and the laws pass, they are facing brutal, cutthroat competition. And it's not just from other crypto startups.
The threat from traditional finance or TradFi is immense.
You have platforms like Robinhood aggressively offering zero-fee trading to capture the retail market. It's a race to the bottom for retail trading fees, and Robinhood brought a rocket ship.
And then you have players like SoFi.
Right, who are leveraging their actual chartered bank status to offer a comprehensive suite of lending and banking services that puts immense pressure on retail transaction margins. If Robinhood is doing it for free, how long can you keep charging retail investors a premium?
It is an incredibly margin-crushing environment for retail, no doubt about it. But again, to synthesize how they are positioned against this TradFi threat, we have to look back at their shields.
The cash pile.
That $11.3 billion cash pile is the ultimate defense against a fee war. They can afford to dramatically compress their margins on the retail side if it means capturing or retaining market share.
Because they are subsidizing those losses with the high-margin institutional custody and SaaS revenue we talked about earlier.
Furthermore, their proactive regulatory relationships are a massive differentiator. The fact that their chief executive is taking meetings at the highest levels of the U.S. government gives them a distinct advantage.
They are building a moat of compliance that traditional finance institutions respect.
And that smaller crypto-native rivals simply can't afford to replicate.
So what does this all mean for the next few months? We've got the incredible revenue growth, the massive cash pile, the toll road layer 2 economics, and the political tailwinds on one side.
On the other side, we have the constant threat of Bitcoin consolidation, legislative uncertainty in Washington, and TradFi giants trying to crush their margins.
If you're a listener trying to map this out, what exactly should be on your radar?
If we are mapping out the catalyst calendar, we are really looking at a highly dynamic 6 to 12-month trade horizon. The next 30 days and the months immediately following are packed with crucial triggers that could dictate the next major move.
First and foremost is the legislative front.
Yes. You have to monitor the progress of the Clarity Act through Congress in the first and second quarters of 2026. As we discussed, its passage isn't just about abstract legal safety, it is a direct revenue unlock.
If the rules are clarified, they can officially begin offering high stablecoin yields to users on a fully regulated platform.
That is a massive, currently untapped revenue stream just waiting for legal permission to be turned on.
And right in the middle of that legislative watch, we have the fundamental reality check earnings. The first quarter 2026 earnings report is expected in late April.
Given the recent price action, the breakout to new highs, and the momentum carrying over from the end of last year, the expectations are going to be sky high.
The market isn't just going to look at the top-line revenue. They're going to demand to see continued margin expansion.
And critically, a continuation of that subscriber growth for their recurring services. If that subscription growth slows down, the SaaS narrative takes a hit.
Absolutely. The earnings call will also likely give us vital updates on their product pipeline. We need to actively watch the monetization metrics for the base network.
Are those sequencer fees actually growing month over month? Are developers continuing to flock to the ecosystem, or is the novelty wearing off?
Additionally, we are expecting the highly anticipated launch of real-world asset, or RWA, perpetuals.
Let's pause there for a second. RWA perpetuals sounds like incredibly dense financial jargon.
Yeah.
What exactly does that mean for the average trader using their platform?
Think of an RWA perpetual like a perfect financial mirror. You aren't actually going out and buying a physical piece of real estate or a heavy bar of gold or a barrel of oil.
Instead, you are buying a digital contract on the blockchain that perfectly mirrors the real-time price of that asset.
And because it's a perpetual contract, it never expires, and you can trade it 24/7 globally.
If they successfully roll out synthetic exposure to these off-chain assets, they are essentially opening up a multi-billion-dollar total addressable market.
It heavily differentiates them from basic spot trading competitors who only let you buy and sell standard cryptocurrencies.
And wrapping all of this together is the broader macroeconomic environment. We have to keep an eye on institutional adoption,
We are seeing heavyweights like Fidelity, Goldman Sachs, and BNY Mellon quietly but steadily expanding their footprints in this space.
which directly feeds into the custody and institutional transaction revenue we talked about.
Plus, right now, we are sitting in a general risk-on environment. U.S. equity services recently hit 3-year highs.
When the broader market is feeling confident and investors are willing to take on risk, growth assets and financial infrastructure plays tend to catch a very strong tailwind. Everything is lining up to make the next couple of quarters incredibly dynamic.
It truly is a pivotal moment, not just for this specific company, but for financial infrastructure as a whole.
Think about this. If their strategy to merge traditional stocks, crypto, and prediction markets into one everything exchange actually succeeds, what happens to the traditional brokerage account in 5 years? Are we looking at the extinction of the legacy banking app?
That's the lowdown on Coinbase Global. Thanks for joining us on the Easy Money Show. Keep your eyes on the catalysts, manage your risk, and we'll see you next time.